Hello everyone and welcome to the Financial Tribune. This is Plaman again, and today we'll be discussing the reason why I'm pessimistic about the current macroeconomic environment. I'll review the three most important markets in my opinion, and then I will make a summary on why I don't believe that things are going to get better anytime soon. So let's start. So let's review the three markets, which are the United States of America, the European Union, and China. So why did I choose those three markets? In my opinion, those are the three most important markets around the globe, because the United States of America is the biggest one, the biggest consumer. The European Union also has some big manufacturers, and also the European Union as a whole is really important player on the global economy. And of course, India and China, the third in my list, and also the most important one. I think statistically China is responsible for 27% of the global production. So if the economy of China doesn't develop that well or goes down, we all go down. As the next step, I'll review the three important pillars of those economies, which are the inflation rate, the base interest rate, and the current economic situation or macroeconomic situation in those three markets. So let's get it on. The first one is inflation. So in the United States, as of November, the 30th of November 2022, which is today, the official inflation rate in America is 7.7%. In Europe, it's 10%, according to the data from the European Union. And in China, it's only 2.1%. Just to give you a little bit of background, a healthy inflation is considered to be 2%. That's usually the target inflation rate in every modern economy. So 7.7 and 10% is really high. That means the economy is going too fast and it should be slowed down, because too high inflation rate makes the currency unstable, it makes the prices unstable, and the local economy in which the inflation rate is really high is trying to play catch up with wages and prices. So that is why stable, relatively low inflation rate, usually at the 2% level, is targeted by the central banks. But as you can see at the moment, in America, it's really high. In Europe, it's even higher. And in China, the inflation rate or the official inflation rate presented by the government data is at 2.1%, which is good. But in America and in Europe, it is really high. Following that information, my next point is the base interest rate. In the beginning of the year, the base interest rate was lower. I think it was about 2% in the United States. Now it's 4%. The American Central Bank has been raising the base interest rate whole year in order to take control or to lower the inflation rate in America, which is somewhat successful at the moment. In order to lower the inflation rate even further, a higher interest rate is needed, and they have stated that they will still rise the base interest rate until the end of the year, and maybe going also further to next year. Maybe not at that high of a rate, but they still need to do that in order to manage the inflation rate, which is again really high at the moment. A similar situation there is also in the European Union. The European Union faces 10% inflation rate and only 2% base interest rate. And in the European Union, they will also have to increase the base interest rate in order to lower the inflation rate. And you should all remember, those are official numbers. Those are numbers which are stated by the official governmental bodies, by each of those states. The base interest rate in Europe will also most probably increase dramatically in order to manage high inflation. In China, the base interest rate is at 3.65%, which is relatively high based on the inflation rate they are having. China is also having rising inflation rates, although they are not as high as the inflation rates in America and in Europe, but it's still rising. Maybe at this point it's a good time to review the inflation rate of China for the last 2 years, and as you can see here, it's also increasing. Of course, not at rates that they're rising at in Europe and America. And this is the base interest rate in America, as you can see from April this year, where it was 0.5%. Now it's 4%, which is this increase is really steep, and that's also what the Fed stated, that they stated that they want to increase the interest rate to at least 4%, and they also stated that it will continue rising going further, although maybe not at that high rate, but it still is most probably going to rise. They also manage those increases based on the most current inflation rate data. So they're making adjustments based on the most current data that they have. But the inflation just don't stay at one certain point. It's a very dynamic key performance index, and it's also influenced by information, by velocity of money, which is how often currency is changing hand, and this also affects highly the inflation rate. So this is like the perceived value of the money when a certain currency is changing hands very quickly, then the value of that in the eyes of the consumer, that currency goes down. That also plays a big role when it comes to inflation. As we have seen the two important metrics in each of those markets, the inflation and the base interest rate, I would like to also take a look at the status quo of each of those markets in order to also get an overview and a bigger picture of how the things are looking out in each of those markets. So the first one, in America, as we've seen, we have high inflation rates, we have rising interest rates, and we have many layoffs. Big tech companies have laid off staff. Amazon has laid off staff. Meta has recently, when Elon Musk bought it, fired over 3,000 people in a single day. Amazon has laid off staff. Meta, which is Facebook, has also laid off people. And all those layoffs combined, they're not good for the economy, since people are losing their jobs and their consumption rate and capability gets lower, which also as a whole lowers the standard of living. And all those events are not good for the market and the American economy as a whole. So in Europe, we also have a high inflation, as we have seen. The base interest rate is really low and it will go higher, which means that the economy will shrink due to the fact that lending money will become relatively more expensive for the companies. We have the war, of course, which is also a factor which brings unpredictability to the markets, and therefore we cannot say if the market can develop well in the near future or not. Also, what the war brought to us is really high energy costs. The gas prices have skyrocketed. The energy prices have also taken a big jump. So this also has affected the relatively high inflation. So the war has affected not only the political environment, but also the economic environment, and has brought quite a bit of unpredictability to the European market, also has brought to us very, very high energy prices, which on its own has further contributed to the really, really high inflation rate we are experiencing at the moment. So this unpredictability has brought us to a very or relatively high unemployment rates, which taken as an average in the European Union. So the rising unemployment rate is, for example, I believe it was in France, Germany, also Italy, Spain. They have over a 10% unemployment rate after also the corona pandemic. And last but not least, the current situation in China. China has set zero pandemic policies, and most recently there has been also protests against those policies and restrictions. Due to that, we have also sinking production and consumption pace, and also they have rising cases, which is also not really good. And due to that, they have lowering production paces and consumption paces. So that means that they are producing less, they are consuming less. So as a whole, what do you think is going to happen? We have really, really hard times everywhere. We have high unpredictability in Europe. We have rising interest rates in Europe and in the United States. We have high inflation rate. We have rising unemployment rate. And we have also socio-economic pressure in the biggest manufacturer country in the world. And having seen all those facts, how am I supposed to be positive? Usually I'm not a pessimistic or an optimistic person. I consider myself to be a realist. And having seen all those informations, and as we have seen in the previous video, which I will link up there, the S&P 500, the biggest 500 companies in the United States, have a negative market trend. So this is the graph of the S&P 500, and as we can see, the negative trend continues, and we have lower highs and lower lows, which means that we are in a bear market at the moment. And this bear market, that's the last year, this bear market has taken place now over a year. So we have yet to break this trend, and I personally don't believe we're going to break this trend, since we have just seen what information I have presented you. And the facts say that the current macroeconomic environment in the most important markets, the USA, the Eurozone, and China, do not look very promising, rather the opposite. Because there isn't a single positive thing I can see from that data. The really high inflation in America and in Europe is a prerequisite for higher base interest rates, which will push even further the negative downtrend of the market. So this is why I'm not very optimistic about making new investments and opening new positions with those macroeconomic environments throughout the world. If you agree or disagree with me, what I've said about this video, you can comment down below, give me a like, and subscribe to the Financial Tribune. I appreciate it. I appreciate all your support, and thank you for the support. I've seen people writing to me and making positive comments. I really didn't expect it to, so thank you for everyone for the positive feedback. I really appreciate it, and thank you for staying with me until the end, and I'll see you next time. Bye bye.